what is actually equity. So equity is the value of your property minus your loan. Lenders don't lend off 100% of the equity. They'll only lend you the usable equity portion on the limit of how far they'll go up to. And a lot of people think that, you know what, I've got so much equity in my property, why can't the bank just give it to me? Well, the banks don't just look at the equity portion, they actually look at your ability to repay. Just because your property is worth $10 million and your loan's $1 million doesn't mean the bank's going to lend you up to 80% of a. Good day everyone, I hope you're well. I'm your host Tony Xia and thanks for joining me on another episode of the Mortgage Chat. Today, I want to talk about what we can use equity for. I've been in the game since 2015. Until today, there are still people that have this misconception on what you can use equity within your property for and what you can't use it for. It's changed a little bit since 2015 for the better, right? As in, what people can use equity for, you know, for consumer use or for commercial use. So today I want to break that down and tell you what we've been using equity for our clients. So let's first break down what is actually equity. So equity is the value of your property minus your loan. So for argument's sake, let's just say the value of your property is worth $1 million and the loan is $500,000. And the difference between that is $500,000. So therefore you have $500,000 of equity. Lenders don't lend off 100% of the equity. They'll only lend you the usable equity portion on the limit of how far they'll go up to. So for argument's sakes, let's just say the value of the property is worth $1 million and the bank will lend you up to 80% of the value of the property without paying any lender's mortgage insurance. Your loan is $500,000. So $500,000 minus 80% of the value of the property is $300,000. Therefore, the bank will lend you $300,000, which is your usable equity portion without any lender's mortgage insurance. Okay. Now, some lenders do allow you to go up to 90%, but therefore you have to pay lender's mortgage insurance on the whole loan amount. Now, it's not very often that we go above 80% of the value of the property to draw equity out for purposes of, you know, investing or personal use, but there are some occasions where it may work for them. Okay. And the main use of equity is actually to purchase properties. Doesn't matter if it's going to be an investment property or an occupied property, right? So this is how a lot of people and a lot of investors out there keep on buying property one after another because they actually keep on leveraging from the existing properties and drawing out that equity to purchase more property. And that's on the assumption that they can keep on borrowing and borrowing and borrowing. All right. So for argument's sake, you know, we have clients that purchased in WA in South Australia 2 years ago, where they leverage off the existing owner-occupied property. They use that equity in the existing owner-occupied property to cover the deposit of the new investment properties. And now that new investment property and the owner-occupied property has grown into more value 2 years after, they can keep on using the equities from all those properties again. And like I said to you, that's how they can keep on leveraging and keep buying. But like I said to you again, it also depends on their borrowing power, okay? And a lot of people think that, you know what, I've got so much equity in my property, why can't the bank just give it to me? Well, the banks don't just look at the equity portion, they actually look at your ability to repay, okay, if you get those loans. So it doesn't matter if I have, you know, a $10 million property and the loan on is in $1 million. What the banks want to see is you have the ability to get more debt above that $1 million. Just because your property is worth $10 million and your loan's $1 million doesn't mean the bank's going to lend you up to 80% of $10 million, right? Because you need to be able to service that loan, okay? And it's a part of consumer protection. You know, they shouldn't be lending money if you can't afford it. Another popular use of equity is debt consolidation, right? So as a consumer, I may have racked up multiple credit cards. I may have racked up personal loans or car loans where I'm paying, I don't know, in excess of 10 to 15%. And my cash flow is quite bad, okay? So to better my cash flow, to save myself some money, I might just consolidate all that debt into my home loan and pay a lower interest rate, you know? So like I just said to you, personal loans, car loans, credit cards can be in excess of 10, 15, 20%. If I can consolidate that into my home loan, I can start paying mid sixes or low sixes in comparison to 10, 15, 20%. So therefore my cash flow is already better right there. And that's why using equity to consolidate your personal debts it's actually quite good, right? You'll be better off financially, and also you're able to pay off that loan faster. A lot of people say, Tony, yeah, but my car loan and my personal loan only has 3, 4, 5, maybe even 6 years left on them. You're consolidating these and getting me a home loan, which is a 30-year loan term, right? I'm stretching out my interest over 30 years. Yes, you are right if you pay the minimum home loan repayments. And when you consolidate these debts, you shouldn't be paying the bare minimum. You should be paying the same repayments as you will be paying before the debt consolidation. Therefore, you'll be paying it off before your original loan term. And why do I say that? It's because if you're still making the same repayments at a lower interest rate, you'll be paying off these debts a lot faster. Okay, guys? Next is using equity to purchase stocks. A lot of people don't understand or know that you can actually use equity to purchase stocks. All right, so I'm not talking about a margin loan. Okay, that's a complete different thing. I'm actually talking about taking equity out in a form of cash in another loan split and using that cash to purchase stocks. Okay, so if you don't know that you actually can use equity to purchase stocks, it's because maybe your lender don't allow it. There are a few lenders out there these days that allow you to take equity out to purchase stock with it. So we do have some clients that want to do that and diversify their portfolio a bit. You know, some in investment properties, some in stocks, etc. Right? So the most I've actually taken out in equity to purchase stock is actually $500,000. All right, and this guy is a heavy investor, knows the stock market, played it for a long time, so that's why he's comfortable in taking $500,000 out. Some banks don't allow it. Some banks require you to have, a solicitor sign, so not solicitor sign off, but financial planner sign off with a statement of advice. Some banks actually just go, yep, no problem. You got stocks right now. You want to increase your stock portfolio, not a problem. Here's your money. As long as you can service the loan, not a problem at all. The next may be for some personal use, right? You know, you want to live life a little bit. You want to buy a boat or you want to buy a car. There's no stopping you. Okay, nothing's stopping you from drawing equity out to buy that. Okay, it's a normal thing. You know, we do have clients that still want to draw equity out and purchase a car with it because they don't want to get a car loan due to the short term and a high interest rate, or you know what, they don't have $250,000 to buy the dream boat, so they want to take equity out and purchase it with cash. Okay, that's allowable. Last but not least, you can actually take equity out or use the equity to renovate the house, right? So for non-structural, so cosmetics around the house, renovating the bathroom, kitchen, etc. If you can service the loan, you can actually draw the equity out to renovate the house. You know, we actually get clients that want to draw equity of up to about 150 to 200 grand to renovate the kitchen, bathrooms, flooring, windows, the whole shebang, right? So they want to renovate the whole house, essentially gut it and renovate the whole thing. But if you want to do structural renovations, such as, putting extension, building a pool, building a granny flat, 99.9% of the time, lenders require you to get a construction loan, okay? So those 5 points are the main points of what people use equity for. There could be other reasons, but those are the main 5 that we normally take equity out for, all right? So therefore, consumer use, okay? However, a lot of people out there don't know that you can actually use equity from a residential property for business and commercial use, all right? So I'm going to give you 2 things. So the first thing is you can actually use home equity from a residential property to pay out business loans, car loans, asset finance, etc. Okay, and you're probably asking me, Tony, why the hell would I want to do this? Well, if you have a business loan right now, you're probably paying around 8-9%. You're paying a line fee every month or every quarter, okay? And maybe you even get annual reviews depending on what bank you go to, all right? If you refinance these commercial loans into your home loan, well, guess what? You're actually going to pay residential rates where it's going to be 6.5%, max 7%, okay? So, and you don't have to pay your monthly line fee or quarterly line fee, right? So you're going to save yourself a lot of money there, right? So for argument's sake, you can have a $500,000 business loan that you're paying, I don't know, call it 8%, okay? But if you revert that back to a residential home loan, you only have to pay around 6%, anywhere between 6 and 6.5%. So you're going to save yourself around 1.5 to 2% margin right there on a $500,000 loan. So the last thing is you can actually use home equity to purchase a commercial property or to purchase a business, right? So obviously, if you want to buy a business or you want to buy a commercial property, you have to have deposit, right? So if you don't have deposit in the form of cash, then you have to bring your residential property in as a security, as long as there's enough equity in it, right? So if you want to buy a commercial property, depending on the price range, you need anywhere between 20% to 40% deposit, including stamp duty, okay? If you don't have the cash for it, then you sort of have to use your residential property as a security for it. You know, for argument's sake, if you want to buy a business for $500,000, but you're not buying anything else apart from the business names, the business operations, the IP, and the goodwill of the business, not the commercial property or nothing else, then you need to fork out at least 50% deposit, depending on what type of business it is. So if you're buying something for $500,000, unless you have $250,000 in cash that you can lay out yourself, you have to use your residential property as a security. And that is a very common way to get commercial loans or business loans if you don't have the cash to fork out yourself. So everyone, I hope you liked this video and I hope I gave you a good understanding on what you can use equity for in both the consumer world and also the commercial world. I'm your host, Tony Xia. Please give this video a like, this channel a follow, and I'll see you next time.